So back in the middle of 2021 and late 2020, when I was kind of pounding the table publicly on energy stocks, after the huge gap in performance, and kind of brief euphoria, I got a little bit more hesitant on them, while still emphasizing that I'm bullish with, say, a 3 to 5 year view. I'm still structurally bullish on energy. I think it's underowned. We don't see a lot of euphoria in options around XLE or XOP. Um, there's really not a lot of, say FinTwit got a little bit excited about energy stocks, but we don't really see large institutional pools of capital just pile into energy stocks. It's just not an over-owned thing. And so especially after this recent pullback, I'm still pretty bullish on the sector. I've also been emphasizing for people that might want a little bit less volatility. I think the energy pipelines are interesting. And so they were very bad performers from 2014 through 2020. They were over leveraged. They were kind of using Ponzi dynamics. They're always issuing debt and equity, and that whole industry kind of right sized for like 6 years. I mean, you had kind of a 1-2 punch. The whole oil price crash and capital pull out of 2015 really hurt them, and then the ones that were still standing, a lot of them were punched down in 2020. But after the dust settled, I think that space is very attractive. I think it's broadly deleveraged. It's rather cheap. It's not highly tied to energy prices. It's more about energy volumes. And of course, the last thing we need right now is reduction in volumes. And so I'm pretty bullish on both energy producers, but with the acknowledgement that there's a lot of volatility there going forward for the next 6 to 12 months. And then also on the pipelines for people that might want 6, 7, 8% dividend yields, that are, I think, probably pretty sustainable if you pick some of the higher quality ones. I'm broadly bullish on a number of commodities in general. That would include uranium and copper and things like that. But their timelines all differ. And so, for example, ESG electrification, I think 5-10 years from now, copper is probably much higher priced than it is now. But at the same time, I've been a lot less bullish on copper than I have on energy, because in a declining PMI environment, copper is more discretionary. If you look at, say, a copper to gold ratio, that generally follows the PMI, Purchasing Managers Index chart pretty closely. And so something I've been tracking since 2021 is that copper rolling over as priced in gold. And so I took profit on my copper miners, but not really my energy stocks, because I think that OPEX, on commodities with ongoing expenditure like oil and gas are more attractive to me in this environment than more discretionary types of cyclical investment like copper. But whenever we do see signs of a bottom in some of these, say things like copper, I'd be a long-term interested buyer after this cycle's over. I've just been more hesitant there. As for uranium, yeah, we're in one of those environments where, I mean, if you're flat year to date, you're not doing that bad, right? I mean, if you compare it to this, the S&P 500, if you compare it to foreign equities, if you compare it to bonds, long duration bonds, flat or mildly down year to date is not the end of the world. And so my general approach with uranium is I for the most part, I prefer uranium itself rather than uranium miners. I think you have a lot less risk there. Maybe you'll get obviously less explosive upside potential. But I think that if I'm comparing, what do I want to own for 5 years? Ironically, a chunk of uranium is probably more attractive than a chunk of dollars or a chunk of bonds, that are kind of programmed to devalue over that multi-year period. Whereas uranium, it's not so much that you need nuclear demand to increase, you just need it to not go down. I mean, if basically it's undersupplied as it is.
Yeah.
And so I think that when you look out 3 to 5 years, prices pretty much have to go up in order to incentivize more production. And so I think that as a slice in a portfolio that is rather uncorrelated with the other assets, I still like uranium. It'll certainly be disappointing at any sort of given 6-month period. That can easily happen. But, considering what we saw in broad asset prices, I'm not too disappointed with what uranium has done so far. So I think it depends on the type of investor you are. I think that futures are good, especially, if you do long duration futures, I think that's pretty attractive here. Uh, because I have a pretty big emphasis on equities, I tend to play the equities a lot as well. And one way to think about that is that, even if say oil just chops along sideways for a few years, many oil companies are very profitable at current levels, and they're able to pay high dividends, they're able to buy back their shares, they're able to strengthen their balance sheet, and they're
Uh-huh.
really not that expensive. And so but obviously you're taking on jurisdictional risk. I mean, a lot of countries can, their governments can come out and say, hey, energy companies are doing great. Let's give them windfall taxes. So you're taking on a somewhat different risk profile. So I think that both are ways to play it. I think when it comes to things like gold or uranium, that are easier to just kind of, have a vehicle to own it long term, or something like gold you can really just physically own. I tend to prefer the risk-adjusted return potential of those compared to their miners. But when you get into copper and oil, I tend to like the producers just as much as I like the underlying. One is the euro dollar system itself, that, during the Bretton Woods era, you had a proliferation of offshore dollars and demand for dollars and offshore credit creation. But then starting in the mid 70s, you also had a deliberate policy by US officials to try to have oil producers, sell their oil in dollars. And then just as importantly, take the dollars that they earned from that and hold treasuries. And so it's really kind of two systems overlaid on top of each other that are self-reinforcing as a network effect. And my base case going forward is that we're going to see some degree of diversification in that system. And Russia's kind of the flashpoint of that, where they're obviously more willing to sell their commodities in other currencies now. And obviously, less willing to hold their assets in treasuries. I mean, even before their foreign exchange reserves were frozen, they already mostly de-dollarized. And now it's obviously, completely. And so I think that we've been in from say the 1940s to the present, we've been in mostly a unipolar system. And I think we're shifting towards a more multipolar system where you have these different axes of power. You at least call it two. So you have kind of the Western powers, and you have kind of say the Asian powers. And you could have three, right? I mean, you can have these different groups. And that's not a narrative that sells a lot, because, most people either want to, they're either like rah rah US forever, or it's like dollar collapse, China takes to the world, whatever. So whereas I think the more realistic view is that, United States has something like 4% of the global population. At our height, we reached over 2/3 of like foreign exchange reserves. I think that, we've peaked in that sense. But that it's still, it's the depth of liquidity in the dollar market is still huge. The network effects are still huge. The size of the economy is still huge. And that instead, I think we're going to see more diversification, especially among BRICS nations, so especially among large emerging markets, to basically engage in a number of different currencies. And with China being the world's biggest importer of oil now, I think they have considerable sway over oil producers. Russia being the most obvious example at the moment. They just announced. I mean, they have record volumes of natural gas going over their pipelines to China, while obviously they're curtailing some of their supplies over to Europe. I mean, we've just kind of seen a shift east there. It still remains to be seen what Middle Eastern countries are going to do. But I do think that China has increasing sway over some of them, as the United States has pulled back militarily, and as we've just kind of changed our political situation. So my base case is towards more decentralization. We've already seen an interest in countries generally upticking their gold purchases over their treasury purchases, because they have essentially a somewhat inflation protected, potentially self-custodial asset that can trade in multiple currencies. They can't be frozen if they hold it. And so I generally see, diversification going forward. I think that system kind of reaches peak centralization. Now we're kind of going to spread out for a period of time.